Welcome to Burns Hustles, where we turn side hustles into cash. Have you ever wondered why some investors consistently make profitable decisions while others struggle? Welcome to the fascinating world of investment psychology, an area that explores the intricate dance between the mind and the market. It's not just about crunching numbers or analyzing trends. It's about understanding your own mind, your emotions, and how they can lead you down the path of irrational decisions. Investing can be a roller coaster of highs and lows, and with each rise and fall, our emotions can get the better of us. Fear, greed, regret. These are not just feelings, they can be powerful forces that drive our investment decisions, often to our detriment. Then there's the realm of cognitive biases. Those pesky mental shortcuts that our brains take without us even realizing. Whether it's following the crowd or seeking information that only confirms our beliefs, these biases can lead us astray. Understanding these emotional pitfalls and cognitive biases can help us make more informed and rational investment decisions. To illustrate this, let's delve into some real-life case studies. Picture this. Your friend earned a hefty profit from investing in a trendy tech stock. You feel inclined to do the same. This is the bandwagon effect in action, where investors are swayed by the actions and decisions of others rather than making independent, informed decisions. It's human nature to want to be part of the crowd, to follow the herd. We often assume that the majority must be right, but in the world of investing, this can lead to disastrous results. Consider the story of an investor who jumped on the bandwagon of a popular tech stock. Every news outlet was buzzing about it, and their friends were raving about the profits they were making. So they invested, without doing their own research or considering if the investment aligned with their financial goals. Unfortunately, the stock's bubble burst, resulting in significant losses. This investor's experience underscores the dangers of the bandwagon effect. Now imagine another scenario. You've invested in a certain stock. You then selectively pay attention to news that supports your decision and ignore news that doesn't. This is a classic example of confirmation bias, an all too common pitfall in the world of investing. This psychological phenomenon occurs when we seek out information that aligns with our existing beliefs and conveniently ignore the information that contradicts them. Let's consider a real-life case study. We won't mention any specific names, but let's say an investor poured their money into a tech company's stock. They were so convinced of its success that they turned a blind eye to various warning signs. They focused only on the positive news, the glowing reviews, the promises of groundbreaking technology. But they missed the red flags. The dwindling cash reserves, the high turnover rate, the lawsuits. This tunnel vision, this confirmation bias led to a significant financial loss. This case study highlights the pitfalls of confirmation bias. As these case studies show, our biases can significantly affect our investment decisions. Investment psychology, the study of our financial behaviors, is an essential tool for any investor. It's not just about crunching numbers or following trends. It's about understanding how our minds work, how we make decisions, and how we can be swayed by emotions and biases. Our biases, whether they're conscious or unconscious, can cloud our judgment, leading us to make rash decisions or ignore crucial information. This is where the importance of understanding investment psychology comes in. It provides us with a deeper insight into our own decision-making processes, allowing us to identify and address our biases. Let's take the bandwagon effect, for instance, which can lead us to jump on the latest investment trend simply because everyone else is doing it. By recognizing this bias, we can take a step back, evaluate the situation objectively, and make a more rational decision. Or consider confirmation bias, the tendency to seek out information that supports our pre-existing beliefs and ignore anything that contradicts them. This can be particularly dangerous in investing, as it can cause us to overlook potential risks or disadvantages. Awareness of this bias can prompt us to actively seek out a variety of information sources thus providing a more balanced view of the investment landscape. So, how can we avoid these biases? One effective way is to diversify our investments. By spreading our resources across a wide range of assets, we can mitigate the impact of any single investment going sour. Another is to constantly challenge our assumptions, to question our decisions, and to seek out different perspectives. Moreover, it's important to remember that investing is not just a financial endeavor, it's a psychological one as well. It's about maintaining a level-headed approach, about resisting the urge to make impulsive decisions, and about understanding our own minds and behaviors. Remember, the key to successful investing isn't just about choosing the right stocks. It's also about understanding your own biases and emotions, and making decisions based on logic and evidence, not just feelings or trends.